look at the stock price. Stock price of Microsoft is 241.22. So you want to get that in your head just so you know what you're working with. And then remember that, so with a stock replication strategy, your goal is to actually protect your money, right? So let me ask you all this question. So remember, out of the money calls are calls that haven't hit the strike price yet. In the money calls are calls that have already passed the strike price. They're already, like you could exercise it right now and still make money. What is a safer investment? An in the money option or an out of the money option? Which is safer? Which one is more likely to give you your money back? Okay, I see Valerie had the, okay, Valerie answered. Okay, good, thank you. ITM, in the money, exactly. In the money is better, right? So first thing we do with stock replication, because our goal is to protect our investment, is we go with an in the money call. And really they say deep in the money. So deep in the money means you're so far in the money that the chances that you're going to end up out of the money are very, very slim. So let's look at strike prices that are like way below this. So let's go to $222.50. So the chances of Microsoft dropping below 222. Actually, let's go to 220. Let's make 220. 220 is our number. Okay. The chances of Microsoft dropping below 220, in fact, actually, let's go even further. Let's really be safe. And let me go further. Let's go to 200. That's it. So 200. So your strike is 200. Okay. So Microsoft most likely isn't going to drop below $200 a share, right? I mean, it could, but it's already dropped a lot, right? Okay. So $200 is our strike. Now, let me ask you another question. Remember, you got to pay for safety. You got to pay for safety. So you've already paid. You're already going to pay a higher premium, even if the option expired on November 25th. You're going to pay $15.20. Or sorry, actually, scratch that. I'm sorry, I got it wrong. You're actually going to pay. Let me scroll up. Did I say 200? Okay. So you're going to pay $42.40 for this option. Okay. Now, also, if you have a choice, if you're trying to protect your investment, and you have a choice between having a little bit of time or a ton of time, which would you prefer? Which is your preference? To have more time or less time? A ton of time. Right. So with a stock replication strategy, you would give yourself a lot of time. So let's move out to, let's give ourselves like a year and a half or something. Let's go all the way out here to January 17th, 2025. Okay. So that's a ton of time. A lot of things can happen between now and then. And now let's look at that $200 strike price. Well, since you're paying for your safety, now your option isn't going to be $42 per share. It's actually $75.50 per share. Okay? And that's a pretty big price point. That's a lot of money. But let's compare. Well, if I decided I wanted to buy Microsoft stock, I got to pay $241 per share. So 100 shares of Microsoft stock will cost me $24,000. But with a stock replication strategy where my money's still pretty safe and I'm still getting a lot of the upside on Microsoft stock, I can pay $75 per share. So 1,000 shares or 100 shares, excuse me, will only cost me $7,500. Why is that a good thing? Well, because let's say Microsoft stock grows. Let's say that over the next year and a half, up in between now and 2025, what's that? Is that a wait? Next year's 2023, so that's 2 years, about 2 years and 1 month. So let's say Microsoft stock goes up from 241 to 271. Let's say so it goes by $30 a share. Well, if I figure out my ROI, the $30 a share would be a nice ROI if I actually put up the capital to buy the stock. But the fact that I put up so much less, I only put up 1/4 or less than a fourth of the capital to buy the stock, or about a fourth, a little bit more than a fourth actually, to buy the stock. My ROI just shoots through the roof. It's much, much higher, right? Now the reason that it pops off that way is because the stock replication strategy allows me to really get some deep ownership in Microsoft stock without actually being a shareholder in Microsoft stock. I also can lose money in this strategy because if the stock doesn't move, let's say the stock sits there, at 241 for the next 2 years, which I highly doubt this is going to occur, then then my options just gonna the time decay is just gonna kind of kick in for the most part, and what I'm gonna get at the expiration is the intrinsic value, which would be 241 minus 200. I could exercise the option at the strike of 200. 200 gives me the right to buy it right at that price. So I paid the money. I can buy it at 200, sell it at 241. So I make $41 per share. But that kind of sucks because I spent $75 a share to buy this option. So I can lose money on this strategy. If the stock stays still, I do not win. But if you believe that Microsoft stock is going to go up like it has over the last several years, then a stock replication strategy allows you to get a piece of that without actually having to put up the same amount of money that it will cost to actually buy Microsoft stock. So deep in the money call options allow you to dig into options to get rid of your FOMO without having to put up as much cash as it costs to actually buy the stock. That's why options are beautiful, and everybody should understand how to use them. Okay. Now, I'm going to answer a bunch of you guys' questions. Before I do that, just a reminder for those of you that just got here, tomorrow at noon, that's when Michelle Walker Davis is going to lead a whole conference on getting money for grant money or government contracts. If you have a business or an organization, she's really good. She's helped people get millions of dollars worth of these grants. You can go and you can actually join. Just go to my website at boycewatkins.com. Use the code word training camp, all one word, training camp, and oh. So let's see. Give me one second. Here. I'm looking to see. Uh, yeah. Tell Keith I got that taken care of. Tell Keith I said thank you. I appreciate it, Keith. Thank you. But I knew that was going to occur, so don't worry about that. It's not a big deal. But anyway, so let me get back. Wait, let me see. I lose my train of thought so easily. But yeah, so tomorrow, so if you use the code word training camp, you can get 40% off. Also, if you want to join the Prime program, just go to drboyceprime.com. Use that code word training camp. So if you join monthly, it'll take 30% off. If you do annual, it'll take 40% off. Those discounts will be in effect for the next 48 hours. Okay, so after 48 hours, the training camp will be done, and we'll kind of part ways. But also remember, you have lifetime access to the entire mini class. As a result of being in the training camp. So if you want to go further and want to learn more, there's still more material there available to you. Okay, so let me hop in and answer some of your questions. Let's see. Deshaun says, "How do I use my affiliate number and the training camp code for when registering?" Your affiliate number, Deshaun. You know what? I'm not 100% sure on that. Check with Chanel or the support team. They might be able to help you with that. You can email support at theblackbusinessschool.com. They can make sure you're taken good care of. Let's see. Danny says, "Can you give an example for an investor starting out with $10,000 to invest?" Yeah, it depends on what you're trying to do with that, Danny. If you're trying to get long-term growth, then I would go back to when we were talking about the SPY or some sort of mutual fund that gives you diversification. I think that's the most important thing you could do as an investor is to start off by diversifying. I wouldn't try to do anything too crazy unless you have a great business idea that you think can make money. But even then, I wouldn't invest very much money until I was sure I was making money. Just as a side note, I'm a believer in dipping your toe in the water. So if you have some extra money and you want to start a business, don't put all your money in before you know what you're doing. Put a little bit in, and when you find something that's making money, then slowly but surely invest more. You want that business to be self-sustainable as soon as possible. You do not want to go dump all your money in there and then lose it all, and then you have nothing to work with. You have to protect your capital base. That's the most important thing you got to do as an investor. Lynn Williams says, "I looked up SPY in stocks on Cash App and found S&P 500, S&P 500 Growth ETF, and Portfolio S&P 500 Value ETF. What are the difference?" Great question. Okay, so the S&P 500 ETF, Lynn, would basically be something that invests in a lot of S&P 500 companies, despite whatever style they are. It's just kind of a nice blend. Whereas the growth ETF invests in what are called the growth stocks, which tend to be companies that are not as profitable yet. They are expected to grow a lot. They're high. What's called their price earnings ratio, which is the price of the stock divided by their earnings, is very high. That means that their earnings are very small, but their price is high. And what happens with that? The reason that will occur is because people expect that stock is going to grow. They expect their earnings to grow. Whereas low PE stocks, low price earnings ratio stocks, are what are called value stocks. These are stocks that either have hit a little bit of a slump, so their price is down, or they have already done most of their growing. They're not going to grow anymore. So those are called value stocks. So ultimately, it's up to you to decide. I kind of like just the main S&P 500, but actually growth stocks are kind of getting their butts kicked pretty bad right now. So maybe if I had to pick, maybe I'd go with value. Alicia says, so we pay to purchase the option, and when it reaches the strike price, we exercise the option. You don't have to exercise the option though. You can sell the option. You can buy an option and sell it in 10 minutes, so you don't have to wait until the strike price. The only time you wait, or sorry, wait until the expiration date. The only time you wait till the expiration date to exercise is if you know for sure that you want to exercise that option. You want to take ownership of that stock. If you do not want to take ownership, then sell the option. Let's see here. At what the value has reached without ever having paid the actual value of the stock. Yeah. You don't have to buy the stock. Options. Think of it again. I use that sex analogy. I hope that's not too weird, but it's like the reason people buy and sell options theoretically is to actually take ownership of the stock. But most people don't actually do that. Most options contracts do not take ownership of the stock. So I compare it to sex because because technically the reason you have sex is so you can make a baby. But most people that have sex don't actually have a baby, right? So ultimately, it's the same way. You're just doing this economic thing. You're making your money on the front end, through speculation, but you're not actually trying to go all the way through and actually take ownership of a share of stock. You might want to